Are interest rates getting close to the end of their rise? Is the bond sell-off sort of into its final phases? It's a little bit long in the tooth. When we look around other indications, whether they be monetary, financial, or macro, a lot of stuff pointing to the end of the sell-off. We've got markets from Japan, JGBs, collateral indications, macroeconomic data from the ISM, which was pretty ugly. The payroll report, which many people want to set aside as influenced too much by hurricanes and strikes and other one-off factors. But more and more it appears, especially with the revisions, that as far as the labor market is concerned, the one-off was September's strength, not the weakness that's been coming since earlier in the year. So you put all of these things together, including other indications in the short run, such as term SOFR. For the first part of the bond sell-off, the idea that the Fed is regretting its rate cuts and may actually pause them in either November or December, that's increasingly being thrown out the window. As I said, term SOFR never really bought into the Fed regret to begin with. SOFR rates continue to move lower, pricing a solid chance of continued rate cuts from the Fed. And the reason why that's going to be the case, which is everything we see in the macroeconomic data, apart from short-run fluctuations and markets all over the world. So we look at interest rates that are rising, and they have been since the middle of September, and they've made a pretty substantial move, but they aren't out of the historical norm. And as always, the fundamental picture, which is what really matters, that hasn't really changed. So while the degree of Fed uncertainty and therefore the future path of short-term rates maybe got a little bit clouded in the mainstream sense of it, in markets as well as macro, nothing much has changed in that regard. And if that's the case, then we would expect at some point this short-run fluctuation, the rise in interest rates is going to turn around and head back in the other direction. So Steve, Mr. Van Metre, let's bring you in here. What is your sense of where the bond market sell-off is? And do you buy into this premise, first of all, that the Federal Reserve was ever even thinking about pausing its rate cuts or going on a slower schedule than maybe people were thinking about just a little while ago?
Jeff, there's no chance the Fed was going to stop cutting rates. I mean, we've heard from Powell before. He feels like he's behind the curve. He wanted to cut before. We're now seeing the revisions of the non-farm payroll report. They're starting to validate that they do need to cut rates. Now, we could argue they're not going to do anything other than look like the Fed is doing something. And that's really all that matters here. But when you look at the macro economy, it is interesting that you see interest rates rising here, because normally when you see manufacturing data decline, you see payroll growth slow, that means that interest rates should be going down, not up, which is kind of interesting because what we're seeing, of course, from the market is this pricing in of a complete Republican sweep. You're talking the White House, Congress, and that's going to lead to what we now know as buy stocks, short bonds, because interest rates can only go up. But what I think is more interesting, Jeff, is that while traders and investors are taking that position, the forces of the macro economy are going to lead to lower interest rates, no matter who's president, who's in Congress, or what the Fed does.
You're talking about the so-called Trump trade, right, Steve? That's the idea that the new Trump administration will come in and be completely different than the old Biden administration. And as a lot of markets do a lot of the time, in these types of periods where things are going in the wrong direction, the idea is something different. Just give me something different and I can hang my hat on that and we'll go in the opposite direction. So in a lot of senses, the Trump trade is simply just, it's different. It's not the same as where we are. And therefore, because where we are is not heading in the right direction, there's a possibility, and we can argue, and the market will argue about how big a possibility that is, that something different will actually lead to something good. When we know that the macroeconomy doesn't work in that way, so it's like some big ocean going ship. It doesn't turn around overnight. And when it gets too far in the wrong direction, it's not so easy to bring it back and rescue it with promises to do certain things. But why would that? I mean, I think the real point here is why interest rates are rising, why the Trump trade might be behind part of that to begin with. It's just the situation had gotten to be so ugly during the summertime. There was going to be some kind of a backlash and retracement to begin with. As you said, the payroll reports that came out this week validated all of this stuff that went into the market, interest rates going down as far as they did into the summertime. The payroll reports were absolutely a mess when you get to the revisions. And that's only the first. I mean, there's everything else beside it. As we've been saying all along, You expected that the data would continue to migrate from stuff that looks solid and resilient and soft landing, and over time it looks less and less that way, and more all the entire list and catalog of economic reports go into the recession side. And so with the establishment survey moving in that direction as well, moving solidly in that direction as well, it's searching for an answer for why interest rates would be rising when the economic fundamentals, and we'll talk about some money fundamentals too, do not argue for higher interest rates. And there is definitely a certain part of the market that looks at, just give me something different here. We need to get out of the situation before it's too late.
Yeah, just because you go back to when, Trump had his first term in office, maybe he will have a second one. We don't know yet. We'll find out, of course, by our show next week, is that what happened. Stocks went up, bonds went down. So, of course, if that's your expectation of what happened before, that's how you're going to trade it. But kind of like you mentioned, the ship of the global economy or the U.S. economy is in a certain direction. Just because you fly in a new captain of the ship doesn't mean it turns around immediately. It still takes a very, very long time here. But I think one of the challenges that I'm seeing, Jeff, is we get these very large revisions going backwards, and we're going to see revisions from this report as well, because the response rate was somewhere like 47.4%. So the idea that there's any accuracy in this report at all to begin with, from the fact that reports are inaccurate due to the data collecting method, this entire report is largely made up based on half of the normal sampling. So as we get more responses from those prior two reports, my bet is they're going to be further downwardly revised. That's what we're going to hear from Fed Chair Powell on Thursday next week, is him being concerned about the labor market. He's not going to be concerned about inflation, and that we're going to have to get a couple more cuts on the books, whether it's a 25 or a 50, probably a 25 and then another 25 in December, before the reality of where this economy is going finally, makes it home to the central bankers, who will cut rates like crazy.
But it's interesting, isn't it, that despite the inaccuracy and the noise of the payroll reports, they only seem to go in one direction, which is really about the struggle that the bean counters and statisticians at the BLS are having. Even with higher response rate, they still bias the data higher, which is what we continue to see. In fact, if you look at the initial reports for 2024, the 9 months up until September, they said that job gains were about 2.09 million, which is not all that great, but 2.09 million was the initial report. What they actually show now, after just these short run revisions, is just around a little bit less than 1.7 million. So 20% of the jobs that they thought were gained from their initial report have just completely disappeared. And what that says is that, the BLS has a certain view of the economy being much better than it actually is. And when you apply that and that factor to all of the data that came in over the summertime, as you're just saying, Steve, it means that the situation is likely a lot worse than it already appears. And it already appears to be heading in the wrong direction. And that's really what the market has been saying. So we go back to 2016 when Trump won the election the first time. You're right. Bonds sold off in 2016 pretty sharply, but that wasn't necessarily because of Trump as much as it was the fact that the economy across the rest of the world in 2015 and 16 had been in a downturn, and it was moving into an upturn phase. Whereas in 2024, the global economy and the U.S. economy too are still in the initial stages, even though it's been a long period of time, of moving downward. So the election kind of falls later or earlier in the cycle than it had the last time around, which is another factor against the idea of this being anything more in the market than a short run rise in fluctuation in interest rates.
Yeah, absolutely, Jeff, because we did see a pretty substantial drop, say, in 2-year yields. Of course, it would make sense there were people that would come in and want to sell bonds because they feel it's an attractive place to do that. But nevertheless, it's the trend of the economy. As you mentioned, when Trump took office the first time, he was at the beginning phases of an expansion. Now we could argue, no matter who gets elected on Tuesday, we're in the beginning phases of a downturn. And so the policy reaction from the markets right now in the short run may be buy stocks, sell bonds, because, hey, this happened in 2016, we're going to see it again. But that trade's not going to last. And we may see a shock over the next week or two after the election, depending on, of course, who wins. If we see Trump retake the office, we may see people come in and dump bonds, but it's not going to last. It's not going to hold, because we know the trend of the economy is weakening and that interest rates follow, of course, growth and inflation expectations. Weakening economy certainly is not going to be growth or inflationary. We already know that.
Yeah, but last time we also had, the short run path or the future path of short term interest rates, Fed rate hikes 2016 into 2017 into 2018. So short term interest rates were rising at that particular moment in time, reflecting, as you just said, the reflationary conditions of the time. Whereas now we've got short term interest rates going down. And it's interesting when you look at term SOFR, and I mean term SOFR, not term SOFR futures, even though term SOFR is derived from term SOFR futures. But basically, the short-term interest rates, or at least what the market assesses as what short-term interest rates at term would be, you look at 1 month term SOFR, that one has never priced anything other than first of all, the 50 basis point cut in September, and then another 25 coming along in November. Never wavered on that at all, even after the September payroll report came out last month. And then 3 month term SOFR, while that one backed up after the September payroll report last month, it's been moving lower again throughout October, which is the 25 basis point cut, at least that's what the market is expecting, in December. So as far as the short-term end of the money curve is suggesting, the Fed was never going to shift from its 50-25-25 plan. And that was despite all, GDP that came in last week, it's looking really strong and resilient. The payroll report, as I said, last September, and a bunch of other data that looked less negative than what we were seeing heading into the rate cut. So the markets are still saying everything is on track for lower interest rates at the short end. And the macroeconomy appears to be on track for continued negative fundamentals. At some point, you put those two things together with a whole bunch of stuff that's going on in collateral, and long end interest rates are going to have to turn around at some point, unless there actually is some kind of meaningful change, which, as you know, elections are never actually that meaningful change.
Right, Jeff. So this is clear reaction by traders and investors, and barring, of course, there's something that they know that we can't see in the data, which that obviously isn't the case because again, as you said, we would see the reaction in short-term rates. There would be some other indicator that says, hey, wait a minute, maybe things are turning around. And if that was the case, again, it wouldn't matter who takes the White House in the next election. It wouldn't matter at all. It would be more of a function of, is there an actual soft landing or a change in the economy where we can see the ship turning? In our case, when we look at the data, particularly when we see the manufacturing data, we see the economy getting worse, not better. And yes, maybe Boeing will sell a strike in the next week or two, but that's not enough to change the trend of where this economy is going, particularly what's going on in the manufacturing sector.
Yeah, the ISM report came out on Friday, and that was pretty ugly. The headline number was 46.5, which was down from 47.2 the month before. This is for October. That's the lowest since July of 2023. The employment index, which is consistent with all the negative employment numbers that we're getting, including the establishment survey, that was 44.4. While that was half a point better than in September, that makes 4 straight months with the employment index of 46 or less, which is firmly into recession territory. And your favorite, Steve, I know you love this, backlogs. The backlogs index fell down to 42.3, which means that even as businesses, manufacturers are cutting back on production, they're cutting back on hours, they're cutting back on workers, and they're still working through their backlogs anyway, which is a recipe for future weakness. So the manufacturing sector, which is a leading sector of the overall economy, is like short-term interest rates, looking worse and worse and worse as we head into the end of this year. And so the elections don't change the fundamental picture. I mean, maybe the best example of that, 2008. We go back to 2008, and of course, we're not saying there's a crisis in the same level of recession and contraction in 2024 as there was in 2008, but there was that same type of impulse that, okay, Barack Obama wins the presidency, very different tone and tenor from George Bush's presidency and everything else leading up to that. And the entire marketplace around the world was begging for something different because everything was going wrong. And Obama represented a huge change from where Bush was, and it made absolutely no difference. Because you get to the first half of 2009 was the worst half year in the labor market and the global economy since the Great Depression. So the election of even a drastically different administration changed absolutely nothing.
Yeah, Jeff, so you're right about, I love backlogs of work. I really do, because we got hours worked. And that's really important because a lot of people are going to focus on, hey, average hourly earnings went up. Well, guess what? They tend to go up going into every recession. So that's not really any news to follow because it makes sense. If I've got 3 employees and I get rid of my worst one, well, I'm probably going to give my 2 best ones a little bit of a raise to stay on. But if I cut their hours, that's even more significant. Now, right now, what did we see? Hours worked were stable, but based on what we're seeing in the ISM manufacturing sector with declines in new orders, employment, and backlogs, it suggests that at some point we're going to see hours work drop. And when that happens, in my view, that's game over because that's kind of like the last straw to hit before the labor market comes unwinding.
Yeah, and it's around the. I mean, it's a little bit here and there, right? We've been talking about this all year. It's the lack of hiring. We've been featuring that and focusing on that since last year. Businesses stopped hiring people, and that has shown up in all of the data, including now the establishment survey. They don't want to hire because they realize the macroeconomy is not worth their investment in new employees. So that's already been established. And then you see various different data sources, not just the payroll reports. JOLTS is another one that suggests that businesses are taking even bigger steps toward managing their cost. The household survey for employment, even though they don't track individual hours, we see conversion from full-time to part-time, which is another big indication that nobody's hiring, businesses are trimming workers. And now we get some slight indications that maybe they are starting to let go. It's not just the ISM manufacturing index, but also, the establishment survey was close to zero in August. It was actually close to zero in October as well. And you make some adjustments for revisions, and there's a reasonable possibility that payrolls were negative in August as well as October. That's 2 months. Doesn't mean hurricanes or strikes. There's 2 macroeconomic months where maybe we are getting an increase in potential layoffs. And that was, by the way, that was something that also came up in JOLTS for September. Layoffs moved up pretty substantially there as well. Even though they're still low historically, it's the trend. And really, that's everything we're talking about here. It's the trend in everything. Anything related to the macroeconomy and the labor market is moving in the wrong direction, to the point that it's not just a little bit concerning. It's something that maybe the Fed will take it to under advisement in its next meeting. It's, as you said, they wanted to cut in July. We know they wanted to cut in July. They did the 50 in September. And you got to believe, given everything that's happened, including the September payroll report, the Fed is looking at everything and saying, we need to keep going. If not, you get going faster. And you put all these things together, fundamentally, interest rates have to reflect what the fundamental economy is, regardless of any short-run fluctuation. So even if there's optimism about politics and everything else, we're still in that same summertime downswing that continues to move and continues to get worse.
Yes.